Welcome back. David Reyes here with you. Thanks for joining me. Great show so far. We've been talking about Social Security, the changes that have been made there, talking about a lot of issues with pension plans. So be careful. If you have a pension plan that you're part of right now and even already receiving benefits, you might want to talk to them, because some of the largest pension funds in the country are looking at reducing benefits to existing retirees. It's a serious problem. So, part of my job and our job as a firm is to help to navigate this terrain. Sometimes I use the analogy of kind of like an ocean, right, or a lake. But let's say an ocean and it's calm waters. You used to look out there and it's all pretty and beautiful, but underneath the surface is a riptide. And that's how I really look at our markets right now. I mean, really, really volatile markets. We've had since August of last year, we've had 4 moves up and down of 10% or more. We haven't had this kind of volatility since 2008 and 2009. And most of your portfolios have gone nowhere in the last year or down, right? That's not good. We need to make money. We need to protect capital. We need to create income streams. So let me kind of let you know what's happening with the markets right now. The Federal Reserve, quite honestly, and the central banks all over the world are basically propping the market up right now. Because I'm going to give you some statistics here and tell you really how, unfortunately, poor the undercurrents of the market are. So you've got the ECB, which is Europe. Draghi is doing everything, throwing the kitchen sink at stimulating the economy. And you've got the United States and Japan that are both doing everything possible to artificially prop up the economy. Meanwhile, we have $19 trillion in our deficits. We have the largest federal deficit for the Federal Reserve. And it's a problem. And it's one of those things that's not going to end pretty, because it's like pushing on a string. You're trying to go against gravity, against the laws of nature. Really, we should just let markets go up and down naturally. And for whatever reason, through arrogance, we feel as a society and as central bankers that we can bend gravity. We can make markets. We can make the markets only just go up and not have recessions, not have bear markets. They're going to happen. We've had 2 in the last 16 years. We're going to have another one probably sooner than later. What do I mean by sooner than later? Probably in the next 6 to 12 months, in my opinion. And I just want you to be prepared for that. And I'm not here to scare you. Our clients are protected against these kind of things, and I want you to be protected as well. So some thoughts for you. Number one, we've had, let me make sure I read this accurately, okay? So earnings growth. Earnings are what drives markets. So for Q1 of 2016, earnings have declined 9.3%. So the profitability of companies has dropped almost 10%. If the index reports a decline in earnings for Q1, it will mark the first time that the S&P 500 has had 4 consecutive quarters of year-over-year declines, meaning that each quarter we've had year-over-year declines, 4 consecutive. It'd be the first time since Q4 of 2008. What happened in 2008? We had a 50% loss in the S&P 500 between 2008 and 2009 in about an 18-month period. That's a big deal. And almost every time you have 2 quarters in a row of negative earnings, you have a recession. It's not recessions really equate to bear markets. I could go on and on and on. The second thing that's really, really important that you should know about is what's called presidential cycles. So election years are really bad years for the stock market, and especially bad years when you have a 2-term president. We had a 2-term president from Clinton to Bush 1. What happened in 2000? Boom, 50% down market over a couple-year period. We had a 2-term president in Bush 2, then to Obama in 2008. What happened then? Boom, 50% loss. Where are we at today? We are at a 2-term president again for President Obama, and we are at all-time highs in the market. We're at high earnings ratios, and we've had these negative growth that's happening with the undercurrents of the market. Remember that I was talking about the riptide. What's happening underneath the surface is a lot more serious than you see every day in the newspaper or in your stock portfolio, because it's kind of gone nowhere for a year, but what's happening underneath the surface is very volatile. There's lots of bad stuff happening. So the question becomes, what do we do about it, right? And I kind of like to look at from the most conservative to the most aggressive. And when I mean aggressive, I'm still being conservative. Meaning that the most conservative you can be is protecting capital. So with guarantees, with principal protection. So one of the strategies we use for a lot of clients right now is if they have, you've ridden this market up for the last, let's say 5, 6, 7 years, your portfolio is near all-time highs, right? What a great idea to lock in those gains, right? Protect our principal, sell high, right? Keep our money still invested, but have the ability to take on lifetime income streams without running out of money. So that's like 101. We want to have something like that in our portfolios. So I would say about 30% of our clients have those type of strategies in their portfolio. Not everybody. The more money you have, the less you need these. I usually say if you have more than $2 million, don't worry about these type of strategies. You have less than $2 million or less than $1 million, for sure you need to worry about these strategies. And from there, we have other strategies that we can talk about. But I want to quote this article. And you may not, I'm kind of a geek, so I read all this stuff. That's what I get paid to do. And there is a gentleman that's one of the smartest guys I know. I don't know him personally, that I read about, and his name is Mohammed El-Arian. And he used to be the chief economist for PIMCO. And he used to run the Harvard Endowment. So he's a smart guy. And he did this interview with Business Insider. And I thought it was really interesting. And the question, it says, you've mentioned, this was the reporter, you've mentioned that asset classes are beginning to behave differently to how they have done in the past, that correlations are changing. How do investors navigate this when they're putting their millions of dollars or their retirement to work? And his answer is interesting, and it's something we have the same belief in. He says, diversification, while necessary, isn't efficient for risk mitigation. Think about that. Diversification, while necessary, isn't sufficient for risk mitigation. You need something else. Cash, alternative strategies, some other types of strategies. So what does he mean by that? So we say this all the time. We call it diversification. We look at portfolios all the time, and these portfolios are what I call diversified. There's diversification within there, but there's a lot of overlap. And when you have an event like 08, everything falls. So what are the other things that this gentleman who used to run the Harvard Endowment are talking about? Well, we use some basically quasi insurance for our portfolios. We're talking about stock portfolios. And so it's insurance-like. So what if I told you we could not only diversify the portfolio, reduce risk, but also have kind of belt and suspenders where we have additional risk management that will actually mathematically, as the market falls, the portfolio value goes up. Okay? It's an addition to risk. It's addition to diversification. If you want to know more about this, please give me a call for a second opinion or to attend our next Reyes Retirement Institute. Learn ways to protect your investments above and beyond diversification using institutional type of strategies, hedging strategies, protection strategies. Give me a call, 1-800-611-1967. That's 1-800-611-1967, or go to reyesplan.com. That's REYES plan.com. Hang on for the last segment. I'm going to go a little further on some of these, the markets and some strategies we're using to both protect, grow, and give you a solid income during retirement. This is David Reyes, AM 760, KFMB.
You're listening to The Retirement Architect, Dave.